In this video, I'm going to do a little bit of an analysis on the last report of the gross domestic product that came out for the United States for Q4 2021. So this covered the time span of October to December. Now, I made a mention in an earlier video how the Atlanta Fed was already making a forecast using their GDP nowcast model that the gross domestic product would grow at around, say, 6 to 7 or 8% on an annualized basis for this quarter. And sure enough, it came out that the gross domestic product adjusted for price increases, so the real gross domestic product, real GDP, came out and grew at an annualized basis at 6.7%. So year over year, the metric has increased by over 5.5%. That 5.5% growth was stronger than what most economists and pundits were forecasting, and it sort of drove a little bit of a bull market into the stocks earlier today before they finally tapered off, and actually stocks ended up down for the week. But the volatile trading has been caused by seesawing economic data. You know, there's inflation that's been rising on one hand, but then we got a strong GDP numbers on the other. There's sort of a glimmer of hope here that we can sort of grow our way out of the price inflation. And is this going to transpire? I'm going to go into a little bit of details on that today. One good thing about this report was that real gross private domestic investment, which can be looked at as the core of GDP growth, aka if you don't have business investment, then you're not going to have jobs created. If you don't have jobs created, people are not earning income. If you're not earning income and not producing things, you have no money to spend on and you have no things to buy. So the driver here, as measured on the GDP front with real gross private domestic investment, shot up and had a strong increase from Q3. This was, about a 6 to 7% increase in one quarter on a real adjusted basis. And definitely some strong numbers to support the idea that, yeah, we're having a strong economy with elevated inflation right now. Now, part of this has to do with the fact that personal consumption expenditures have been lagging for the last two quarters. So in Q1 and Q2, we had high growth in real personal consumption expenditures, even after adjusting for inflation. And the reason why was because of the stimulus bills that were passed by the U.S. federal administrations under the President Joe Biden. And then we started seeing those start to lag off in Q3 and Q4. Now, Q3's had weak economic growth on an annualized basis of about 2%, but Q4 had the rebound of an annualized basis of 6.7%. And as I've made a note here before, I believe what drives these, this strong domestic investment here is abstaining from consumption. So whereas the typical Keynesians believe that it is consumption and investment adding together that grows an economy, I believe that there's a trade-off. You can't have more investment and more consumption. One's got to give. And this abstaining from consumption and an increase in savings has boomed the private domestic investment. Now, what I've done here on the blue line is taken the gross private domestic investment and subtracted out the consumption of fixed capital, so it shows you what your net investment is in the economy. And the red line is net savings. So net savings is private savings plus government savings. When we see that net savings is positive, we see a strong correlation between that and gross private domestic investment or net investment. And that's what I want to point out here, is that the two are positively correlated. The more that we save, the more business investment we will get. The more business investment we will get, the stronger GDP growth we will assume. And that's what we're seeing right now in this fourth quarter. So definitely some good things that we're noticing here. On another good front, we're seeing also all-time lows on default rates and delinquencies on loans, despite the fact that the Biden administration's protections on mortgage forbearances and rents has come to an end, and the fact that these are still remaining and staying low, certainly a good sign about the stability of our economy right now. And even when we take a look at the gross output numbers, because the producer prices came in with a surprising drop at the end of December, so that slight drop, that helped kind of buoy the producer side of the economy, which we can measure with gross output, a broader measure of GDP. Gross output can be looked at as the total sales of the economy, while GDP can be looked at as the net income of the economy here. And I've made a couple videos before, about how real gross output would possibly go negative in quarter 4 or early 2022. And I'm coming off of that dire prediction now, and the reason why is because we're seeing a slackening in prices right now. Now, prices could reemerge and reassert themselves on an upward inflationary spiral, yes. But overall, even though I'm pricing in a producer price inflation rate of around 15% for 2022 and all, it's not really enough, combined with consumer price inflation, to actually drag down real gross output to the negative here. So we're beginning to see signs emerge of a narrative here, I believe, that we may be seeing some calming down in the inflation numbers. So there was a risk that inflation would not stop, annually speaking, at about 7%, but actually grow up to 8, 9, or 10. And I've covered videos on this before, but it basically has to do with this confidence in the US dollar. If confidence starts to shake in the dollar and we start to plummet, and say we get down to what we were in the 1970s, where more and more people were spending goods, saving less, consuming more, investing less, that would lead to more shortages, which would then lead to higher prices, because businesses would mark up prices in wakes of excess demand. You would have higher producer prices, so businesses would be incurring higher expenses on the input fronts, which also factors into higher prices on the output front here. But now what I think is emerging is that we're probably going to see some relative price stability hover around the inflation numbers, and it will keep these inflation rates subdued. Why do I think that's happening? Well, what I honestly think is that I believe that because the economic situation is so dire outside of the U.S., foreign capital is flowing inside of the U.S., and this foreign capital is booming our real gross domestic private investment. It's also booming from with people saving more money, relatively speaking, consuming less money despite prices going up. And because of that, it's having positive effects on our economy, which is increasing gross output. We're seeing a manufacturing and construction boom, so to say, develop so far, which hopefully will keep prices low, and especially as COVID elevates. So based off of that, I've come up with sort of an inflation projection. Inflation is going to stay elevated, I believe, for most of 2022. So by no means are we going to see a normalizing of the inflation rates. But if I'm right, what I think is going to happen is that the inflation rates are going to peak at around 7.5% next month, and then slowly taper off till they end up around year-over-year inflation of just under 6% by the end of this year. Does this mean I'm going to be right about this? Who knows? I could be right, I could be wrong, I could be somewhere in between, and that's probably where I'm going to be, is somewhere in between right and wrong. I'll be right on some things, wrong on others, as typical on this. Nearly impossible to tell, because the confidence in the dollar is shaky. But anyway, what I'm anticipating here is that on an annualized basis, when we take a look at the one-year inflation trends, we're probably going to see a little bit of a shaking in the U.S. dollar, but the overall confidence rate level in the U.S. currency is going to remain high. So the 3-year average inflation rate from 2020 to 2022 is probably going to hover around 5% annual inflation. That's certainly going to be high. That's certainly going to lead to elevated interest rates, which will cause lagging growth, but it is not necessarily something that will crush the U.S. economy. The U.S. economy is not going to be crushed by price inflation, I don't think. I don't think that's the real risk to this. Overall, annual inflation will probably end up around 4 to 4.5% over the course of 10 years, as long as confidence remains high. That's not going to be the issue, I don't think. What I think is going to be the issue is this, and I've covered this before, but this is the default rates model that I've created, highlighted in red, that predicts the rise in defaults and delinquencies on loans. There are three factors that I think go into defaults and delinquencies on loans, okay? One is a drop in income earned, aka a drop in GDP. The second is the amount of debt existing in the system, and the third is the interest rate. Now, consequently, the model has been very predictive of the past three recessions, and even sort of predicted that there would be trouble or problems developing in our economy sometime in 2019 or 2020, which we did have a banking crisis caused by banks being overwhelmed with too much debt in the system in late 2019, and then we obviously had the COVID recession in 2020. Although I don't find that to be very predictive, because that was more done by an epidemic, caused by an epidemic that ravaged the globe, not really something that was predictive of some type of breakdown in the market system. Now, with that being said, what was the driving factor in all of this? Well, when we look back in history, the model would tip and start spiking, indicating problems developing in the economy and rising default rates when the Federal Reserve would lift and raise its federal funds rate, okay? And so far, the Federal Reserve has kept its federal funds rate at 0%, which has caused the model to remain relatively stable here. But pricing in the Fed's rate hikes, as we assume, and factoring in the bank prime loan rate as the federal funds rate plus 3%, which is what it's historically been for the past 20 plus years, then when the Federal Reserve if and when the Fed raises rates to about 4.5%, or raises the Fed funds rate to 1.5%, causing the bank prime loan rate to raise to about 4.5%, we're probably going to see a breakdown in the economy. To put it simply, there's too much debt in the system at those interest rate levels for GDP to handle, and it would cause a rise in delinquencies and defaults on loans in the coming months and years, which would lead to a breakdown in the economy. It would lead to bankruptcies and losses and layoffs. People would start losing their incomes. The stock market would crash, much like it did in 2008. There would be huge catastrophic impoverishment of society, and it would be looking like the Great Depression, probably sometime in 2024, 2025. That, to me, is the real risk. What it seems to be is that what's going on right now is that the problems of inflation will start to ease as we go into the second half of 2022. It does not mean that inflation is solved or gone away. By no means. The Fed will have to raise rates and start engaging in quantitative tightening in order to rein in that price inflation. But what will replace it with is a deflation of credit caused by inabilities to repay back that debt due to liquidity being sucked out of the economy, which in turn was caused by excess debt created by too much liquidity flooding the economy in the previous phase. If that makes it clear as mud, I'm not surprised, but essentially it goes like this. The Fed prints money to grow the economy, which causes defaults and delinquencies on loans to drop. But then during that low interest rate phase, more loans get created. Too many loans, as a matter of fact. And then for one reason or another, whether the Fed thinks the economy has recovered, or in this case, when prices start to go up, the Fed raises interest rates. When it raises interest rates, it raises the cost to borrow money for all of those loans. The economy becomes dependent on having more and more loans created to keep the economic cycle churning and more products producing. When that valve gets shut off, when businesses lose access to that credit, or if the cost of credit goes up, that's when the crash ensues, that's when layoffs begin, and we get a rise in unemployment and an economic recession. That's what I'm seeing develop right now based off of this trend that strong GDP numbers are appearing, and they're probably appearing because foreign investors, in part at least, are piling into the U.S. economy. Another thing that's been facilitating here, and I privately mused about this is that, ironically, with government easing back on its expenditures from earlier in 2021, this is having a positive real effect on the economy, as less relative amounts of government spending from its high peaks is allowing more private economic growth to occur. The government is crowding out less of the markets. Now, this can reverse if Joe Biden manages to get another stimulus bill passed, or if the Republican administration buys into the argument from the Democrats that stimulus or infrastructure bills are needed to grow the markets. But for right now, that's what I'm seeing. And I think that, combined with the sour nature of the global economy, is keeping the U.S. economy afloat, staving off that price inflation and causing strong GDP numbers. Certainly something for Joe Biden to gloat at, but I don't think it's really been a product of his own creation. It's really been something that he stumbled backwards into it like Mr. Magoo and got lucky off of this. Does this mean that the high growth numbers will continue? No, not by any means. And with the Fed raising interest rates, raising the cost of borrowing into 2022, we'll probably see a lot of this growth start lagging off. But the benefits of this is that we'll start to see some of the price inflation ebb over time. The risk, we're going to see a bubble burst, a credit bubble burst of megalithic proportions that will crash the U.S. markets in the coming years. And that's going to be disastrous. Guys, let me know what you think about all of this. I'll be glad to hear what your comments are. I'm going to release a couple more videos in the coming days that's talking about the current market situation and what's been developing. I know I've been seeing some questions and requests from you for me to do some updates on earlier vids. I definitely will get around to producing those in the coming days. Just hang tight. But I did want to give you out this GDP analysis report while it was fresh on my mind and as I was doing a little bit of digging numbers, as well as give you some updates on some charts and tables that I have been compiling. Guys, if you like the content that I produce for you, make sure you show me some support. The best way you can do that is to click that like button, subscribe to my channel, click the notification bell so you're notified as soon as I upload a video. And if you want to have a comment or question, drop a comment below. I read them. I try to read every single comment, and I'll respond back to most, if not all of them. Once again, guys, I thank you for watching this video, and I'll talk to you next time.